Okay, so for anybody that's watching this live, coming in late, or for anybody that's going to watch this as a recording later, this is going to be our Catalyst team's quarterly market webinar update. We're going to break down what's happened in the Iowa multifamily marketplace in the last 3 months. This is Q3 2025. Specifically, we are going to highlight the Des Moines market here. Now, what I want to just start off with right at the bat is how we define the Des Moines market. It varies. Some say the Des Moines MSA, some just say the Des Moines market in general. How we define that is a 35-mile radius around the Des Moines metropolitan area. What that's going to encompass for anybody that's watching this or thinking about this, that's going to encompass places like Ames, Iowa. It's going to encompass Newton, Iowa, Adel, Iowa, and to the south, Indianola, Iowa as well. Those are about the four major cities that are hubs or around Des Moines that will be included in this report or are included as much as possible here. Those data points aren't as easily accessible for sales, rent as well, but we compass them as well. It works out to about a 4 or 5 county region. It'll be the Polk County, Dallas County, Story County, Jasper County, Warren County. Those 5 counties are essentially what we encompass in this report. And so with that being said, I am going to kick us off here and jump in. I believe everybody can see my slides here as we get rolling. And for those of you who do not know who I am, this is the Catalyst team's, again, market update. As always, some people have seen this before, some have not, but I'm gonna kind of go through some hashtagging moments. Thanks for coming in today, joining me. Right now we have Wes on, so Wes, thanks for coming in and even just talking earlier about some fun stuff. My commitment's always to all of you, anybody out there for his clients, is I'm pretty honest and open. I like to be transparent. I never want to conceal information or feel like anything's being hidden as well. So my job is to be open and honest, transparent. That's why we always say trust through transparency. And then my job also is to present facts. So I present as much facts as possible here and try to let you all as owners, sellers, buyers make the best decision for you and yourself and your portfolio as well here. I just want to present facts and be open and honest. But once in a while, I will share my opinions. These are only my opinions. These are not the beliefs of anybody else, so don't sue me or anybody else. If you want to sue me, at least make it a big dollar amount so I can at least say I'm in a big lawsuit for a big number. At least make it worth all of our times. And I can at least brag I've been sued by a big number, even though I'm not even close to worth it. In this webinar, we're going to analyze the quarterly update data from what we've seen from July 1st now to October 1st of 2023 here. Sorry, 2025 Q3 as well. We're going to hear some stories about the marketplace and what's been happening as well. And then we're going to hopefully get some information what we think the market is doing or going to do will help us hopefully make more money all at the same time. Because at the end of the day, that's all we want to do here. We want to utilize the data to understand the story of the market, and then we want to use that data, that information to hopefully analyze it and trade on it. I mean, no different than stocks, trading information, we're going to do the same thing. We're just trying to do it on a real estate basis. I always have this picture in here because I love it. Maya Angelou, it's a picture of a mountain, just because I love mountaineering and climbing, for those of you who don't know. But you can't know where you're going till you know where you've been. And so all of us who are seasoned investors understand to know this, even new ones, is that remember that everything that we are looking forward to in the future is all of us trying to make a prediction of what is going to happen by previous things, by past events. Black swan events like COVID and other things will happen, and they will always change everything as well. So we try to look to the past to build models looking for the future. But at the end of the day, no one knows what's going to happen in the future. Everything is just going to happen as it comes. We just use our best pictures of the past to look forward here as well, which is what this is going to be all about. Looking back over the last 3 months, 6 months, past 9 months, even past 5 years, which we're going to go into what that means and why. First things first, for those of you who just want to get through the first 5 minutes and get out of this webinar presentation early if you want to get off, going to give you the high points. This was a massive quarter for sales volume in Iowa. And it was because of the largest sale in the history of Iowa. It's the Denner portfolio. We're going to break that down. But that sale drastically changed all of our numbers. And it officially introduced international money, international capital into the Iowa marketplace here. So for the first time now, Iowa, specifically Des Moines, Iowa, can say that we are attracting international level of investment and finance. And for those of you who are wondering, over the last 5 years, pricing is up anywhere from 24 to 29% on values. Over a 5 year period, it works out to about 4 to 6% annualized return. We're going to break down what that means. But that's generally speaking what has been happening over the last 5 years. So for all of you who got a few things out of this presentation, if you wanted to just quit now, be done. Those are the major points, but we're going to break down what that looks like. As always, I go through this all for anybody who has never seen this before, doesn't know who I am, for anybody maybe watching this online later on and just kind of stumbled upon this. Why would you trust me? Why not just go listen to someone else? Well, again, I'm Jared Huseman here at the Catalyst team. And here's just kind of an experience I've had as an agent. I've been an agent now for over 10 years. I've personally completed over $100 million of transactions for clients and myself. This is not me boasting. I'm on a team of 10 agents and we've all done 10 million and together we've all done 100 million. No, this is me personally, intimately hands-on every deal over 100 million transactions in a marketplace where our average sale price is much lower as well. So some people will say, oh, I've done a $1 billion transactions. Well, if you're in Shanghai, Hong Kong or something like that, it might be easier to do a one transaction be $1 billion and say you've done a lot. So that's what we have. My average buyer right now is averaging 26.95% IRR. So I think our stats are above average when buyers listen to me on what to buy, and sellers listen to me as well, but when to sell sometimes. That also includes sometimes having to buy and sell in the meantime. Again, as I said before, this is all just me by myself, just me and my admin staff. We've only had a couple agents on the team off and on, but none of these stats are working for them. This is just me and myself. And my agents on my team have since come and gone, and they've done their own deals as well. So why I became an agent, honestly, I always say this, I hated agents. Most time when I was investing personally, I've been an investor now 15 years. When I was investing personally, I found that agents only ever called me when they wanted me to buy a deal or sell something. They never called me and asked me how my deals were going. They never came and offered me lender relationships or title companies or mortgage companies or maybe other bankers, managers. They just called me whenever they need me to buy or sell something. They were very transactional. And I didn't want to do that. I didn't want to be transactional. I wanted to be personal and I didn't want to hide behind performas. So a lot of the numbers you'll see us, the Catalyst team, put out there are real numbers, real models, not just, oh, well, if this property, if you increase all the rents 300%, it'll be a 7 cap. No, we try to hit real numbers here and we don't hide behind bugs performa as much as possible. We tell you the full story, the full picture. If we do put out a performa, which we do at times, we'll be able to back it up with real data, real insights, and real knowledge on the market, not just saying you're going to get $12 a month rent because you have a little one-bed studio in a bad part of Des Moines or something. And so I think that's what good agents should do. I think good agents, in my opinion, should be very personalized. They should help you all understand the story about a property when you are buying it specifically. If you're selling a property, help you make more money on the sale or the purchase, whatever that may be, by qualifying the buyer, understanding your needs, your wants, your goals, and then help you expand your thinking. That's also a really important thing. Sometimes we all get stuck in the weeds about focusing on one property. And I think part of the job of a good agent is to focus on the larger picture, which is, hey, what's happening regionally, nationally, internationally here. Me at the Catalyst team here, I'm the CCM, you might see in my title. I have many relationships across the country. I talk to agents on a daily basis, quite literally, all across the country. I am a coaching student as well. I actually coach. So some of my clients range all the way from California to Ohio to Mississippi to Texas. And I've got plenty of friends also in Florida, New York, as well as Illinois, Minnesota. So I have some friends over in Washington State, Seattle as well. So all of my contacts are helping me keep a close eye on not just what's happening Iowa-based, but regional and nationally. And these are conversations I have quite literally on a daily basis. And it's information I try to bring back here to Iowa to help us all look at what's happening. If I missed anything that you want in agents, as always, I always say throw it in chat. I always try to be here a value, a source for you guys. I know in the past we've done things like occupancy reports, rental growth reports, etc. We tend to have a short list of managers, property managers, buyers, etc. Banks. If you ever need those, let us know. Happy to help. And again, anything else you may look for, let us know. I will happily build it all for you because you guys are all the clients. This is a quick picture of the Excel sheet, data Excel sheet I track. It's a lot of information in there for what it looks like. It's been about actually closer to like 8 years now. It's not 6 years, a little bit outdated. 8 years. I spend anywhere from 2 to 4 hours minimum, if not longer, every quarter sourcing and tracking all this data. So it works out, I'm not even sure how many hours. That's been 50, 60 hours of just data sourcing and resourcing, maybe more, getting all this data pulled together. And as I always say, it's available to all of you guys. You guys just call me. I'll give you stats, give you information. I won't tell you maybe who the buyer is. Maybe I will, or the seller is. But I generally know what's going on in the marketplace. Overall, it's about 120 pieces of data on each sale. There it is for the last 8 years. So I need to update that last slide. So about 8 years or so. It works out to about 52,000 pieces of data entry on, again, just the Des Moines apartment market. This is not office, not retail, it's not residential. This is just the Des Moines multifamily, and kind of looks at the matrix there. And then what I did this time, typically a little differently here, is I plug all this data into AI and started analyzing some questions here as well. So AI is very useful. It's very big. It's a huge thing. It's a buzzword. AI gives a lot of information here as well. So I plugged all this into AI. I'm consistently doing that more and more in the last year, and asking AI to help build some theses and some things as well. Now, we all know AI is great, but there's an old story for all those old farts who say bad data in, bad data out. It's used to be used for computers and the internet back in the day. So AI is great, but you have to ask it the right questions. You've got to give it the right prompts. And this is why they always say curiosity is easy. Just make fewer statements, ask more questions. And so all the questions that am going to pose on this webinar, and even as opposed to AI, was all just questions that I'm thinking about and things I'm wondering about. And I'm hoping questions that clients are thinking about as well, all of you out there as well. So I have those questions there. If anybody has any questions they want me to prompt AI on and get a response back, just either shoot me a message, text me, email me, drop it in the chat, and I will literally put that prompt into the same AI I used to build this, and I'll give you this answer back. So if anybody has any questions on maybe they want to ask my AI with all this information here, I'll happily ask it on behalf and see what it says. And the reason I say my AI is because it already has all the data and the questions in it. So I don't need to, give that to you as well. Looking through a lens, we're going to really spend a lot of time in this presentation, especially near the end part of it, looking over the last 5 years. And the reason why we're going to focus on the last 5 years is because that was the last time we had the massive record-breaking sales that took place this last quarter. And so, as I said earlier, we've got to look back to look forward. That was the last time we saw a big sale, so we can utilize the last 5 years, what's happened since the last big sale, to kind of predict what we think the next 5 years is going to look like for the Des Moines, Iowa multifamily marketplace as well. So very hard look at the last 5 years and typically what's been happening here. And we're going to use these hopefully 5 years to predict what's going forward in the future. And so before we get started here, again, for anybody who wants just a quick picture, quick stats, here are some of the stats of what we saw happening in the third quarter 2025. First things first, massive sales volume. $347.3 million of apartments traded hands in a 3-month timeline. That's literally almost 103 million, 115 million per month. It was massive. We saw $116,360 as the price per unit, $123.03 as the price per square foot, and the average cap rate based upon actionable data is 6.3%. That is actual cap rate, again, on actionable data, not pro formas, not stuff we couldn't totally find information on. That's actionable as well. Why these statistics? Why do I focus on these 3 things, not other things? Some of you may see this before, but just kind of a quick recap of why we follow these statistics, especially for any new investors. We're going to jump into what that looks like. Just as we get started here, this is just a fun picture of me in the desert in Dubai. It's my presentation, so I get to put in fun pictures and make the theme whatever I want. And so when I put in a quick recap, it came up with a picture of a guy doing a 4-wheeler through a desert. And I thought, I don't need to use some online picture for that. I'm going to use my own picture for that. So it's my online picture of me in a 4-wheeler in Dubai having fun. And so my presentation, so I get to put whatever I want in. So if you see these pictures in here, it's all going to be from my Dubai trip. Again, Why these numbers here? Why is it important here? So first off, sale prices, pretty obvious of why it's important. It helps us know what property values are, plain and simple. Sales volume. This is tracking how much got sold. For lack of a better word, this is the heartbeat. This is the blood flow through the market here. When we see no sales volumes, our blood pressure is very low. We don't have a lot of blood flowing through the system, through the body, through the organism of the Des Moines multifamily marketplace. When the blood flow is high blood pressure kind of thing, then we see a lot of sales volume going through, which we actually saw this last quarter as well. So it's really important to track that sales volume, to track the heartbeat, the blood flow through the marketplace. Sale price per unit. The reason we track price per unit, it's a very common metric to track in the multifamily world. And the reason why is it helps us compare apples to apples. There are 3 ways to evaluate property if you follow the commercial level guidance. There is comparable approach, income approach, and the rebuild approach. Price per unit is a great way for us to compare apples to apples. If this property sold at $116,000 per unit, what will the property next to it sell for at $116,000 per unit? So it's the red apple to the green apple. It might be a little bit different, but they're both still apples as well. The price per square foot. We really want to track this as well, because what we're tracking there is the second method, which is the rebuild approach, which is essentially saying if we go out and buy an apple today, what would it cost us to go buy some apple seeds, and what would it cost in time, dollars, whatever it is, watering, organics, nutritional value to grow those apples and to have our own apple as well. What would it cost for us to build a new apartment complex as well? So really important. That helps us track the second metric for evaluating property on a commercial level. And then of course, cap rate, which is sale price divided by net operating income. Focus there is on net operating income. It does not include bank financing like that as well. That is purely net income before any kind of debt. That's income from a property. What that essentially tracks is, okay, we have an apple here, that's great, but what's an apple good for? It's only good if we eat it or make it into something else. So the income from a property, I always say, is the apple juice from the property. Here's the apple juice, what we want. One of the things I think many investment groups make, some especially newer ones I've seen, is remember that if you buy rotten apples, you're going to get a bad apple juice. You're gonna get a bad flavor. If you buy quality apples, you're gonna get quality flavor. And so one thing we need to always look at too is what is the quality of the product as well you're buying. And that even ties back into the earlier comment about the rebuild approach. So we need to always be thinking about, is this a quality property that we're buying? Because again, the income is a derivative, which is a fancy word for something from something else. But the income is a derivative from the property itself. And that's what the income is. That's why the cap rate is really important to track. And then these stats all together tell the health of the marketplace. They give us comparable valuation, the rebuild valuation, and the income valuation. And utilizing all 3 of these metrics together, and again, cohesively, not just one, but all 3, we can get a better idea of the price of the market, where things are going, where things are not going. We can then use this to sell to banks, sell to appraisers, or to buyers or sellers, whatever it may be, to make more money. I'm assuming no questions so far. Western, no one else, any questions so far? Cool. We're going to keep rolling. Let's start diving into the marketplace. This is again a picture of me looking crazy hair in the Deep Dive Dubai underwater pool. It's the largest underwater pool that you can actually scuba dive in the world. It's like 300 feet deep. There's another picture of it later. It's really fun. You'll see some fun pictures of me scuba diving here coming through the market. So let's dive into really what's been happening now. So the last 9 months, we're having some fun. The last 9 months, we have seen 96 listings hit the Iowa multifamily marketplace. Now this isn't across all of Iowa here. What you can see, we saw 27, 35, and 34. What you notice there right off the bat, you start seeing those numbers accelerate coming into Q2 and Q3. Not by a lot, it's marginal, but we are seeing listings increase as we're coming in later in the year. That is most likely a prediction of interest rates coming down and the market getting better. Also, debt starting to become due that was all lent out on 5-year money. Now, what I want to tie into is that this is 96 listings across Iowa in the last, give or take, 36 weeks of the year. What that works out to is that we're seeing on average right now across all of Iowa, 2.5 listings per week hit the market, whether you're in Des Moines, Waterloo, Sioux City, Council Bluffs, Cedar Rapids, Iowa City, whatever it may be, we're seeing about 2.5 listings per week. Probably a little bit more here because some of those eastern markets, Cedar Rapids, Iowa City, Davenport, do not always list on the open market. They transact quietly on their own MLSs. So it's probably even more than that as well. But that's what we can actionably track. Now, what's interesting about this is I went down and tracked how many of those listings were all in central Iowa here in that 35-mile radius. We saw 46.9% of all iListings were happening within the Des Moines marketplace, which actually equates to about 47 listings in Iowa so far in 2025. Again, 47 listings over 36 weeks is a little over 1.5 per week, all to central Iowa here. And again, central Iowa is making up almost half of the entire marketplace here. It's worth noting that Des Moines by itself is the major hub, pulling in investment from all the rest of the state. Now, when we look at those numbers and we look at number of listings so far in 2025, we saw 47 listings with 46 sales so far to date. Now, what that's telling me is that we're seeing a balanced marketplace. For a little while there last year, we were seeing more listings at the market and not many sales, not many transactions. And we were seeing about a 2-to-1 ratio. Now we're seeing about a 1-to-1 ratio, which means that buyers are coming back into the marketplace. Buyers are coming back into doing deals here. And so this number of listings to sales really tells me where things are at in terms of capital. That's why I wanted to look at those numbers. And so again, as I said a little bit earlier, we're starting to see the market turn a little bit there. For about a year there, 2024, 2023, we were definitely seeing a buyer's marketplace. Now we are starting to see, again, a little bit more of the marketplace turn, and we're seeing more and more money coming into the marketplace and more listings happening. Most likely it's due to interest rates coming down. That's the biggest driver of interest in our marketplace. But there's some other factors we're going to talk about as well as we get into everything here. So any questions so far on number of sales or listings in the marketplace in Iowa in the last 9 months?
What's your minimum just to get into that list? Is there a minimum like dollar size, or are you not counting like the smallest duplex I might see across the street? What's
Great
actually in
question.
that?
Yeah, thanks for that, Weston. Yeah, so how we track things here at the Catalyst team is 8 plexes and up. We do not track 4 plexes or duplexes. Once in a while, we'll see a portfolio of like 4s, like 3 4s as a 12, maybe it's on the same lot sell as well. So that is just tracking 8 plexes and up. I also want to point out that there have been a few times where listings have reemerged because the agent has shifted who they work with. They might shift from CBRE to Marks and Millichap or CBRE to JLL or vice versa. They might make a shift. When they shift and they shift those listings, we do not recount them as a new listing. Because it's already listed for the last 3 months underneath the same agent, it's not going to change anything. Or once in a while, we will see also an agent bring a property to market, not a success selling it here. We'll see the same property come back out for sale and a new agent. Again, we don't retrack those sales because at the end of the day, the property hasn't changed, the price hasn't changed. It's just the agent representing it has potentially changed. So we only track properties that have been listed originally and only tracking 8 plexes or better. So hopefully that answers that question as well. And I think the key there I want to point out is, again, the biggest key is we don't track re-ups or renews. I've seen at least multiple times over the last, especially the last year or two, agents bring property to market, they not sell, they hire new representation, and they bring it back out. And everybody says, oh, it's a new listing. No, it's not a new listing. It's just hit Crexi or LoopNet or CoStar or the MLS Zillow new, but it's not new. It's been out there for 6 months. Everybody's seen it before. So I want to make sure I really point that one out. Now we're going to start diving into here again a little bit of the market over market, quarter over quarter metrics here. So if we look again at that Q3, we've already seen most of these stats here as well. Again, just reiterating it: 347 million, 116,000 price per unit, $123 price per square foot, and a 6.3 cap right here. What we want to look at now is what's been happening from essentially the last 6 months. What did Q2 look like versus Q3? Well, we saw a massive volume increase. The second quarter of the year, we only saw 26.5 million of apartments trade hands. It was mostly smaller, older projects. We saw 347 million trade hands. So again, the hockey sticks went straight up for sales volume. How does that affect price per unit? Well, the last 6 months, Q2, the average price per unit was 71,759. Q3 is 116,360. And then the average price per square foot also went up about 25%, $99.64 on average to about 123.03. So again, we really saw Q3 just hockey stick everything up in a dramatic fashion when it came to everything. And cap rates also went down, which makes sense. Cap rates go down, prices go up. That's how they work inversely. Cap rates went from 6.59% to 6.3%. So what does this tell us? Again, what's been happening overall in the last 6 months in the marketplace? Well, again, I've been saying, I'm going to keep beating this dead horse. Huge increase in sales volume, massive number. It was, again, the largest single deal in history. That's a big thing. But what I really want to point out to is this. Look at the average transaction that was taking place in the summer. If we look at May, June, July, give it that April, May, June timeline. The average property selling back then was 20 units built in 1966. The average property that traded hands in the last 3 months, 157 units built in 1982. Now, the biggest thing there is, yes, we saw the number of units trade hands, and again, the newer dates, but the biggest metric that's going to change isn't necessarily the dates, is the number of units. It's a 7x increase. Actually, a little more, almost 8%, 8x increase. If we take the sales volume and increase it by 8%, 26 million times 8, you get almost the exact same number. It's a huge difference in what was trading here. The asset type has changed drastically over the last 6 months. So really, at the end of the day, like, why do you care about all this? What does it all mean for you? What does this really all mean? It's really simple. It's something we've all probably been seeing. Family's been in the market long enough. We all know this, but these large apartment sales are driving our marketplace. Period. End all, be all. Right now, I always say the tail's wagging the dog. And I'm going to go into what I mean by that a little bit later on. But these large sales are driving marketplace, and they are affecting everybody here. For any quick stats for my sellers and buyers out here, this is still what we're seeing pretty much average. If you own property that was built in 1960 on average vintage, you're going to see about $70,000 per unit, about $100 per square foot, about a 6.5 cap rate. Varies a little bit, but it's close. 1980 style product, $90K per unit, $120 per square foot, 6% cap rate. 2000s build, about a 5.75 on actuals, cap rate, $110 per unit, $140 per square foot. And then that 2020 price point, if you're brand new, a couple of years old, about 130,000 plus per unit, 160 per square foot, 5.25 cap rate. That's just basic, quick, knee-jerk reactions for anybody looking to sell or buy right now. It's going to vary, but that's what you're going to have. What I do want to point out, though, is this. There's almost a 200% difference from 1960s product type to 2020 product type. 70,000 per unit to almost 130,000 per unit. $100 per square foot to almost 160. Not quite 200%, but it's dang close. And why we are seeing that price point difference, the answer is replacement cost. This is why it's so important to look back to construction cost, price per square foot, because we have to really look at what's it costing to replace property and what's construction cost. This also is helping explain why we've all seen insurance costs go up. Not only are we seeing a lot of hazards such as floods, fires, derechos coming through and hurting in premiums, but the cost to replace that property is much, much more. The rebuild value has gone up so much, and that's why insurance companies, when they're saying, hey, look, this 8-plex, this 12-plex, you might have only bought it for a couple $100,000, but if we had to insure this to replace it, we had a total loss on it, fire damage, it's going to cost 2 or 3 times more to replace that project right now. And that's why we're seeing these huge costs go up. And this is, again, why it's so important for us to look at what new construction is doing, because that new construction will pull up older property values prices. It'll also affect them for higher insurance premiums, which we're all seeing here, and it's actually gutting a lot of people here. But as long as this continues to happen, we're going to continue to see older properties appreciate and pull up. The question becomes, at what point does that gap stop to grow? At what point does it become, okay, we're no longer going to build new, we'd rather just go buy old and renovate? Because at a certain point, we're going to have that cost gap widen where it's, hey, why would I go build for $300 per square foot when I can go buy for $100 per square foot, renovate in, and be in for $200 per square foot? That's a general thesis here. I don't have the answer for it. It is a question I'm watching and thinking about in the marketplace. And it's a question we should all be thinking about, is at what point does that gap change? Don't answer for you here, but it is worth thinking about. And as we're watching new construction pricing, always be watching that because it'll help us for insurance rates. But if you want to see me at underwater at ATM cashing in money, which is me, this underwater thing, if you want to check on the value to dive deeper into your property value, your ATM value, just give me a call. We'll do an analysis on your property and see where you're at. And again, that's just me underwater having fun on the ATM, just because that's a really fun city to play in. Now, as we summarize the last 6 months, again, 26 million to 347 million, $116,000 is a per unit. 123 per square foot, cap rate 6.3%. Any questions so far in the last 6 months of the marketplace? All right, seeing none. Now we're going to roll into the next portion. We're going to dive a little deeper here. By the way, this is a picture of how deep that pool is that I was diving into. It was apparently 60 meters deep, which works out to whatever, I think 220, 250 feet deep as well. It's deep in our pool, and it's kind of a fun one. But let's dive a little deaper here. Let's dive some deeper in the market here. Let's look at the last year. What's happened over the last year, not just the last 6 months. Give us a little wider lens, a little wider subject matter of what's happening. Year over year, if we look at Q3 2024, sales volume is still up massively, 83.4 million to 347 million. I had to literally change the axis on that graph because it was so massive, 300% increase. But how did that affect price per unit? Well, it went up. Not 300%, but it did go up. Price per unit year over year up from 96,834 to 116,360. But our price per square foot actually didn't change as much as you might think as well. 95.43 to 123.03. Very similar to that Q2, Q3 to Q3, the last 6 months of the last year. Very similar metrics here coming in on the price per unit and the price per square foot. And cap rate, very similar as well. Last year, the same time last year, we were seeing 6.25% actual cap rates at 6.3. Now, this cap rate number here, I find it very interesting because last year interest rates were actually lower than they are today. So last year interest rates at the same time were at 3.78. This year, they're at 4.15. I find that really interesting because the Federal Reserve, everybody says, has dropped rates the last couple of months, last year or so. What's happened is the Fed has dropped rates, but the real borrowing cost has actually gone up because people aren't believing that short-term marketplace. They aren't believing they believe a recession's happening, so they're demanding more money for that as well. So I find it very interesting that we see almost a 35% difference, a 35-point difference interest rates, while cap rates have remained the exact same, which tells me that there is more international, national money willing to buy in our marketplace for these lower cap rates, even though they're not getting as good return on their money as they would have a year ago. So looking back again to go forward, this is what the last year looks like when we put them all together. We're seeing sales volume increase, price per unit increase, price per square foot increase, and cap rates remain the same. Let's look at the average property trading hands last year. Average property trading hands last year, a little bit larger, 62 units built in 1972, but not quite 157 units built in 1982. So a little bit newer product, a little bit bigger product here, which probably explains the little higher price per unit, the higher price per square foot, the lower caps, and the better sales volume. Now, looking a little further here, let's start pulling back the weeds. This is where we start going into the 5-year trends. So now we're looking more at the 5-year trends. We're going to get above the clouds here and look out a little further. Now, we're not going to dive deep now. We're going to get high, get above. This is a picture from the Burj Khalifa. It's the highest skyscraper in the world. So this is looking out above the haze. Literally, this is above Dubai. This is the city of Dubai beneath me here, as you can see the pictures. So just for fun, that's what it looks like that high up. What I want to pull back to, though, is December of 2020, almost 5 years ago. And the reason why this is the last big sale to take place, the last thing that happened that really spurred on. This was the BBK to Spruce sale, 555 units, 55 million. It was the first introduction of institutional money investing in Iowa. Prior to that, we had seen syndication groups, we had seen individual investors, but we had never seen Wall Street level money come to Iowa. And it was the first time we saw that happen. and it kicked off. It was a catalyst, pun intended, by the way, for big money coming to Iowa here. Ever since then, we've seen 50 deals completed in the last 5 years that were all over $10 to $20 million. Before then, my metrics don't even track $10 million deals because we didn't even see them. They weren't even commonly done. In the last 5 years, 50, that's actually 10 per year happen that are over $10 million capital money. What that looks like is this. This is actually a graph pulled straight from it. We've seen 2 deals done from Canadian groups for 236 million, average deal size 118 million. 6 from New York, average deal size 28.9. Illinois is buying for 25.9 million, Colorado 29.2, and et cetera. You can kind of work your way all the way down to Iowa. Iowa doesn't really matter there. That's just one local guy buying a big deal. It's not quite accurate because it's only tracking the big sales. But you can see here, we're seeing a lot of money coming in from all across Illinois, New York, Colorado, and now California, now Canada. So Iowa goes big. What these deals equate to, these 50 deals, is 1.3 billion of capital invested in Iowa in the past 5 years. That's billion with a B. That almost equates to, on average, about 10 deals per year, about $250 $300 million of transactions happening in Iowa any given year right now. And they're all $20 $30 million deals. If we see about 10 of these deals per year, we're seeing about 200 million or so per year trade hands, about 10 large deals happening out of about 60, 70 transactions. What does that look like? Well, here's what it looks like on the deal count distribution here. These big deals, these $10 million plus capital markets, equate to 12.9% of all transactions. So only 13% of all the transactions equate to 65.8% of all sales volume in the last 5 years. So if you follow the Pareto principle, it's 80-20. If you follow the Pareto principle even further, you can actually say that 64% of deals are made up of the top 8% or so. It kind of works inversely. It's a bell-shaped curve. We are absolutely seeing that happen in our marketplace. How are these sale prices, though, affecting pricing in general? Well, let's look at something here. What I was curious about, this goes into my questions, by the way. What I was curious about looking at these deals is, okay, we're seeing these large sales, but what's that doing for smaller properties? What's that doing for 8-plexes, 12, 16s, 24s? Are we seeing these large properties sell more? We also assume these properties are selling and they're selling for higher prices, but I really wanted to compare apples to apples. Or maybe a better word is like maybe an apple to a grape or something. I don't know. And I wanted to see what it looks like here. So if we look at newer projects, specifically newer than 1980, which is attracting most of the national and international capital, newer apartment units built at 1980, over 100 plus units. What was the average appreciation rate over the last 5 years? This is the graph mathematically, and it says that 5.2% was the average appreciation over the last 5 years of newer, larger projects. Now, what I want to point out then is, look, over the 2023, 2024, we really haven't seen much. So pricing has been flat over the last 2 years as rates have gone up for almost everybody. But over the last 5 years, we've seen it dramatically go up even further in 2021, 22, where it really spiked it. What's interesting to me about this is that smaller, older projects, anything that is less than 100 units, is appreciating at 4.4% on average annually. So it's still going up, not as bad as you might think. What it actually looks like is, yes, of course, big properties are appreciating for more, but the gap's smaller than I expected. It's only 0.8% difference. So these large property sales, much as we might all hate them sometimes as individual investors locally, they are helping all of us little guys pull our values up. It's attracting more and more money into our marketplace. It's keeping things higher. And again, we are seeing a gap there, but it's not as much as you might think overall. But the question I still had here is, what about inflation? Yeah, we're seeing pricing go up, but who isn't seeing pricing go up right now? If you went to McDonald's lately and bought off the dollar menu, it's not even there. Like the dollar menu now is like a $3 burger, not even like a dollar anymore. It's like inflation's everywhere. So I wanted to look at next is, okay, well, how are prices adjusted for inflation? Like how much are we really going up overall? Well, I put that into ChatGPT, asked to come out AI, and AI is saying that on the last 5 years, inflation is just over 4%, 4.2. That's the gray graph on the left. if we compare inflation to newer properties and older properties is in blue, newer properties is in yellow, we can see that most of the market is beating inflation. Now, rents, we're gonna talk about rents a bit later on, but rents are not beating inflation. Rents are, in fact, getting crushed by inflation. We're gonna go into that later. But right now, we're definitely seeing older properties and new properties beat inflation. But here's what it looks like on a line graph. So inflation's 4.2%. You kind of see there, it's kind of hazy. Other properties 4.5%, new properties 5.3%. What that actually means is that new properties are beating inflation, but only by about 1% annually. Not much, just marginal. Older properties are beating inflation as well, but very marginally, 0.3%. So we are still seeing more and more capital attract to that new project because at least it's beating inflation by a full percentage point. So what I'm getting away from this here is that international and national buyers are buying in Iowa because they are looking just to beat inflation or keep pace with it. Right now, even in the last 2 years, things have been flat. They're still beating inflation overall. And so I think that's why we're seeing more and more national buyers come, is because they're saying, hey, look, you're a great hedge against inflation. And what also points out to me is that if you are not implementing value add strategies, you are only keeping pace with inflation. This is why it's so important for any buyers out there, any current ownership groups. Make sure you are utilizing some form of value add, whether it's operations, whether it's fixing property up, increasing rents, whatever it is. Tries to get some kind of value add, because otherwise all you're going to do is keep pace with inflation. And if that's the case, you might as well put it in the stock market. Way less headache, way less hassle. Just being honest with you, it's a little more liquid. If you're going to invest in real estate, make sure you're at least beating inflation and doing better than what we're seeing here. Only my opinion. Again, just sharing with you here what I would do. But again, takeaways, these large sales continue to insulate our market and pull us up. Simple as that. These large scale ones are beating the national trends and making us profitable. The cautionary signs that I was talking about and thinking about here is that the Iowa apartment market, multifamily, has changed drastically in the last 5 years. Like I said earlier, $1.3 billion invested in Iowa in the last 5 years. This is something that has never happened in Iowa previously. And so, as mentioned earlier, we look back to predict forward. Well, we cannot look in Iowa history and see 1.3 billion invested in apartments ever any given time. It's just never happened. And so I do think some of the old ideas about Iowa or the Midwest being stable, always going up, are going to be challenged in future years. I'm not saying they will be. I confirm that. This is just my opinion, is that right now we have seen the market fundamentally change. And so to look back and say, well, it's always been stable, we always go up in value, we always go up in price. Not necessarily, because the entire market dynamics have shifted. And it's shifted in a way that we've never seen before. And so I also want to be cautioning everybody out there who is investing to say, hey, look, prices are going up right now. We're beating inflation. Doesn't mean it's always going to happen. And so before you jump into selling or buying anything, just call me. This is me skydiving, by the way, in Dubai, jumping head first. And before you do anything, though, let's just have a conversation. Let's reflect on your goals, the market. Make sure you're all making the best decisions for your possible self, and hope to make you all some more money. So prices are going up. We're beating inflations. I'm still curious, though, about what rent rates are doing. That's a lot of people here still own property, continue to own property. So our net income's higher. We kind of already alluded to this earlier, but we're going to talk about it anyway. So looking at cash flow, rent growth, expense escalation, rent rates, occupancy rates. Last year, so far the last year, rents have only gone up by 0.8%. Less than 1 point over the whole last year. If we look to 5 years, 5 years, we've only seen rent go up 2.5%. Very marginal, 2.51% annualized. If you're looking to buy or sell, make sure you utilize 2.5% rental growth models. That's what we are seeing right now. But if you're having expenses right now, which we all do, you're seeing about 4.2% annualized expense inflation. We saw earlier. So what does that really mean when we compare them? Well, net incomes are down. Simple as that. In the last 5 years, rent has gone up 2.5%. Inflation's gone up 4.2%. We can put the math together. You have seen net income without value add strategies go up 1.7% negatively. So you're probably getting less cash than you were getting in 2020 or 2019. It's just how it's working. And you're probably already seeing that now in your head feeling going yes. Worth noting, though, is This is only without value add strategies. If you are implementing value add strategies of some kind, you may still be seeing good cash flow, similar cash flow you haven't seen. Hopefully you are. That's why we keep encouraging value add strategies through fixing stuff up, raising rents, and specifically operations. RUBS as well is a great way to put some utilities back on the tenants, some other things you can do. So that's all I want to point out. But in summary, values are going up right now. If we compare against inflation, 0.3 to 0.9%. And if you're newer property, older property. But generally speaking, property values are going up and beating inflation. So your value is going up, great, but your net income cash flow is going down. So that's just right now where we're at. You're seeing kind of the dichotomy. Values going up, rent, net cash flow is going down. Just how it's happening. For rents right now, this is the average rent for Des Moines. Hold from CoStar, $858 for a studio, $998 for a 1-bed, 2-bed, $1178, and $1401 for a 3-bed. What I found interesting about this stat is that when we actually look at it over the last time I pulled these numbers, rent is down. So I found that very interesting that rents are actually down over the last 6 months slightly. So very interesting for me to see. You can kind of see that little bit of that dip in 2020 at the very near there as well. So very interesting to me. Occupancy rates, 8.5%. It is not good out there right now for occupancy, to be quite honest. People are struggling to find qualified residents, qualified tenants, and we're seeing some of the people high as 10% or higher. So it has been challenging to get rents in. Some other things, though, I'm watching the morning marketplace I want to talk about here before we end too much is development of new units versus absorption. Des Moines' overall population growth, which may save us, could change things. And I also want to talk a little about the ability of residents to pay higher rents that we're all seeing, these 858s, these 998s, etc. So what's happening in the development world? Well, per CoStar, we saw 1,788 units are being developed right now in the last 12 months, with about 1,080 units absorbed in the last 12 months. So we have new pipeline coming to 1,788, but we only saw 1,000 be absorbed last time. So this could translate to higher vacancy. Just apples to apples means we're going to have it here. But these are actually numbers look like. I did pull numbers, so I'm going to do some quick math for you here. Right now, we're seeing about 1.26 annually in population growth for all the Des Moines marketplace. That means about 9,499 new residents. At the average household of 2.5 people per household, means we have 3,799 new apartment formations, specifically new apartments. If we take the 8,219 vacant units plus the 17,000 units under development, we come out with just at, ironically, 10,000 vacancies in the future, in 1 year from now. If we take the 10,000 vacancies minus the population growth, the new apartment formations of 3,799, we should have vacancy of 6,208 in 1 more year. That equates to 6.4% vacancy rate estimated next year. So what I mean by this is that right now we're 8.5% vacancy, but I'm predicting about 6.5% coming in next year. As we see these developments taper off, less developments happening, but we see population growth continue to happen. We're going to see people moving in, and occupancy should get better. So that's some good news for all of us looking out for the next 12 months. But what I want to make sure we point out as well, we always think about is, can these new residents afford the rents we are charging or want to charge? Well, this is the Des Moines average medium income. This is just medium income, just pulled. Obviously, residents make less money than maybe a higher homeownership rate. But if we take the average metric, they should be able to afford, if they're an individual, $800 per month. That's about 25% of their income per month going towards housing. That's just a general rule of thumb we all use. If you have a household, a boyfriend, girlfriend, husband, wife, whatever it may be, they should be able to afford at least $1,332 in rent. So just know if you're targeting those 1-bed efficiencies, you can probably get about $800 a month rent. You're probably starting to cusp, get near the end of that as you get to that high level. If you have some 1-beds, 2-beds, depends on the size of the units, locations, you maybe will get to that $1,332 a month in rent before you start breaking the bank. Anything higher than that, you start looking at a much higher income. So that sounds there. Good. What does this mean for values in the marketplace here? Values are going up, but only if you're using inflation here or value add to come against that. Smaller larger assets are appreciating similarly, very similar timelines. And Des Moines growth, continues to boost values and increase investment in our marketplace. For cash flow, for rents, Growth in rent is less dramatic. It's slowed quite a bit, 2.5%, and vacancy rates are higher, but hopefully beginning to stabilize by next year. Locals are still doing a lot of smaller deals. We're seeing actually a lot more in that 8 to 16 unit range here. Definitely a long-term investor mindset here. And it's investors looking to capitalize on past mistakes other investors have made by predominantly buying those 24, 36 unit complexes. And we're seeing actually a lot of those come out to the marketplace right now on discount. Syndicators are really slow right now. We're not seeing a lot of syndication groups buying. If they are buying, they're predominantly buying townhomes right now, buying packages of townhomes together. That's where we're seeing a lot of syndication money coming into the marketplace here. So if you have townhomes as ownership, we see a lot of syndication groups buying those. But again, syndicators have been pretty quiet the last 3 to 6 months. Institutions, of course, are buying the big stuff, which we've all seen. If you're selling right now, for any advice to sellers out there, if you're selling, know the type of buyer you're targeting and know the experience right now. Again, targeting an international buyer, national buyer, to a syndication group, to a local buyer, all very different. So if you're going to sell, let's make sure we're targeting the right buyer and their experience. Let's also remember that with inflation still running rampant, we need to have a plan to counteract that inflation through some kind of 1031 or investing in some kind of similar asset, maybe Bitcoin for all I know and care. Let's make sure we're keeping an eye on inflation. Also, we're seeing a lot of people consider investing into retail, office, industrial, triple net lease assets here as potentially a offset for that. If you're out there looking to buy right now, having access to banks and capital is very, very important here. Many regional banks in Iowa, I won't say the names, but specifically have tightened up. And so that local lending or having access to larger capital is really important. And we're seeing deals start to appear in that 16, 17 unit range. As I said earlier, 26 or 24 to 36. We're starting to see some of those deals see cracks. And so it's opportunity for local high net worth individuals to jump in on some of those deals as well, as long as you have strong operation and strong value add plans as well. For anybody looking to hold here on the property, not looking to buy or selling right now, our advice just right now, prices are neutral. So really, if you're going to hold, it's okay. Don't do anything. Just hold steady here. Interest rates are set to come down further. They're actually a little higher than they were a year ago. So just hold off any refinancing. Basically, just hold. Just hold. Do your own value add. Maybe have value add for other people as well. But if you're just holders, just continue to do value add and just ride the storm out. Simple as that. In conclusion, on just simple pricing, prices are stable over the last 2 years. Over the last 5 years, though, prices are up pretty drastically across the IR multifamily marketplace. However, those are only keeping pace with inflation, and this new capital is continuing to build our pricing up, as well as construction prices and costs continuing to push things forward here as well. So pricing is still going up here, and over the last year stable, but 5 years longer term picture, we're seeing prices go up. For anybody with their in rent growth is slow, 2 to 3%, marginal right now. Expenses are increasing faster than rent growth. So we're definitely seeing net incomes challenged as well. The good news is these high interest rates have insulated new home ownership in the marketplace as well for buyers. So that is the one silver lining here for anybody out there, is that we are seeing new home ownership formation slow down quite a bit as well. And now it's time for Q&A, which we have none, looks like, on there. This is my contact information here. Jared Huseman, Catalyst team at KV Commercial, 515-639-0145. For any questions, feel free to reach out to me, text me, message me, direct mail, whatever it is, and be happy to chat a little further. So with that, we're going to hit stop share here, and we are going to hit stop recording and sign off.